One person gets completely wiped out by the market. Another builds a steady income stream like a well-run business. Where does the difference lie? Not in indicators, not in some mythical strategy. It lies in six invisible decisions. Decisions that 99% of the crowd have never even realized exist. Picture it this way. You don't need to learn hundreds more setups. You don't need to switch to a new system. You simply adjust six critical points, and 80% of your losses disappear automatically. Not because the market becomes easier, but because you've flipped the right switches. And these are the six hidden switches. Factor one, choosing the right market for your personality. Wall Street has never been just a place to buy and sell. It is a psychological battlefield. And if you step onto the wrong battlefield, you will defeat yourself long before the market ever touches you. Let's face the truth. Without filters. If you are introverted, calm, and risk-averse, yet you insist on trading gold or cryptocurrencies, you are not investing. You are locking yourself inside a furnace. Gold offers large profit potential, but its volatility is violent enough to rip through a stop loss in seconds. A stable mindset cannot absorb the shock of watching an account evaporate 5% in a single 5-minute candle. The outcome is always the same. Either you cut losses too early out of fear, or you hold losing positions in desperation. The system collapses, not because the strategy is flawed, but because the operator is out of sync with the asset being traded. Now look at the opposite side. A young, aggressive trader addicted to speed wants to see money materialize instantly. If that trader is forced to trade blue-chip stocks growing 10 to 15% per year, impatience will quickly turn into frustration. And frustration always breeds impulsive behavior. Discipline breaks, leverage increases, derivatives enter the picture, just to chase the feeling again. Here is the raw truth. Boredom destroys discipline faster than any market crash ever could. Seasoned traders do not hunt excitement. They seek the monotonous repetition of a profitable process. And to achieve that, you must learn to love the rhythm of the market you choose. Ask yourself, seriously, what does your lifestyle look like? Can you sit glued to a price screen for hours at a time? If the answer is no, stay away from scalping during the London or New York sessions, no matter how glamorous it appears. Your personality may be far better suited to swing trading or position trading on higher time frames, such as the 4-hour or daily charts, where you have the space to analyze, breathe, and make decisions driven by logic rather than adrenaline. News trading demands lightning-fast reflexes and extreme stress tolerance. If you need time to think, events like non-farm payrolls or Federal Open Market Committee announcements will crush you without mercy. The subtle but brutal truth is this: personality determines time frame, and time frame determines profit potential. Choosing a market is not just about selecting Forex, stocks, or crypto. It is also about selecting the right type of asset. In Forex, major currency pairs such as the euro-dollar or pound-dollar offer deep liquidity and clean technical structure, making them suitable for beginners or traders seeking stability. Exotic pairs, by contrast, come with wide spreads and erratic price behavior and are reserved for traders with large capital bases and high risk tolerance. The fatal mistake is copying someone else's portfolio without realizing that it was designed to serve their psychology and pain threshold, not yours. If you are constantly breaking your own rules, do not rush to blame the system. Chances are the market you have chosen is in direct conflict with your nature. Alignment between trader and market is the most powerful invisible force of all. It determines your ability to maintain discipline and, ultimately, your net profitability. Choose the battlefield where you can fight with reason, not with emotion. Factor 2, choosing the broker, the foundation of net profitability. If Factor 1 is about choosing the right battlefield for your psychology, then Factor 2 is about choosing who supplies your weapons and logistics for that battle. And here is an uncomfortable truth. You can run a system that wins 8 out of 10 trades, yet a poor broker can still grind it down to break even, or even net losses. This is not opinion. This is cold Wall Street mathematics. Hedge funds survive by adhering to a single principle: optimize fixed costs and eliminate counterparty risk. In retail trading, the broker is your largest counterparty risk. Most traders glance at the spread and reassure themselves that they have chosen wisely. But that is only the surface. The real damage happens beneath it, where profits are quietly drained away. First, execution speed and the reality of slippage. When major news hits and the market snaps violently, you click buy or sell, but the fill price is not the price you saw. That is slippage. With brokers running weak infrastructure or outdated technology, slippage becomes routine, especially on stop loss orders. A 2-pip slip may sound harmless, but multiplied across hundreds of trades, you are silently transferring a significant portion of your profits to the broker. For scalping or intraday trading, where every pip is blood, slow execution is enemy number one. Wall Street has always understood one truth. In high-performance markets, delay equals loss. Second, regulation and capital safety. This is the foundation of peace of mind. If your broker is not regulated by top-tier authorities, such as the Financial Conduct Authority, the Australian Securities and Investments Commission, or the Cyprus Securities and Exchange Commission, your capital is sitting in an unnecessary gray zone. Financial law is brutally clear. If your funds are not segregated and protected, you are not an investor. You are an interest-free lender. When a broker collapses or commits fraud, capital can vanish in an instant. Regulatory protection is not an expense. It is mandatory insurance that every professional trader willingly pays for. Never trade capital safety for the illusion of saving 1 or 2 pips in spread. Third, total cost structure. Spreads and commissions are only the surface layer. Beneath them lies swap. If you are a swing trader or position trader who regularly holds positions overnight, negative swap can erode long-term profitability day by day. A broker with low spreads but high swap fees may be ideal for scalpers, yet disastrous for longer-term traders. The subtlety lies here. Choosing a cost model aligned with your time frame and trading frequency, an essential extension of Factor 1. In summary, choosing a broker is not about choosing a name. It is about choosing a business partner. A high-quality broker provides a transparent, fair, high-speed environment with a competitive overall cost structure. Etch this core principle into your thinking. The money you make in the market is the market's reward, but the money you keep from the broker is the part you protect yourself. Factor 3, timeframes, the trader's positioning map. If the market is an ocean, the time frame is your periscope. It determines whether you are seeing a minor ripple or an entire tidal surge forming beneath the surface. And here is the cold truth. 90% of losing traders fail because they cannot align their vision across time frames. They hunt for the perfect entry on the 5-minute chart while completely ignoring the dominant trend unfolding on the daily chart. The result is disorientation inside market noise, followed by confusion over why the system doesn't work. Professional traders do not view the market like gamblers. They operate under a rule as rigid as steel. Big picture first, details second. This is multi-time frame analysis, the foundational mindset of institutional trading. The nuance lies in one critical principle. Signals from higher time frames always carry far greater weight and reliability than those from lower ones. A clean buy signal on the 5-minute chart may look compelling, but if price on the daily chart is pressing directly beneath a historical resistance zone, that mouse click is not a trade. It is a low probability wager. This is where most profits are lost, not due to lack of skill, but due to lack of perspective. Wall Street teaches one simple yet brutal lesson: never stand against the primary trend. And the only way to identify that primary trend is through higher time frames. Macro time frames, weekly, daily. This is where you define the dominant trend and the most critical support and resistance zones. This is the positioning phase, where you decide whether, for the week, you are only looking for buys or only looking for sells. There is no ambiguity. Tactical time frames, 4-hour, 1-hour. Here, you observe pullbacks within the larger trend, read market structure, and prepare for continuation opportunities. This is the planning phase. Execution timeframes, 15-minute, 5-minute. Only when direction and plan are clearly defined do you drop down to lower timeframes to execute with tight stop losses and controlled risk. This is the execution phase. A swing trader may only need the daily and 4-hour charts. An intraday trader is best optimized using the 1-hour and 15-minute charts. The fatal mistake is trading impulsively across timeframes, 4-hour today, 5-minute tomorrow, creating psychological conflict and destroying system consistency. Mastering timeframes is mastering vision. When you apply multi-timeframe analysis, you construct a powerful filter that allows only signals confirmed by the higher timeframe trend to pass through. This dramatically improves win probability and significantly reduces the risk of being pulled into market noise. Let the higher timeframe determine direction, and let the lower timeframe deliver the optimal entry. Factor 4, trading sessions. Where big money speaks, Forex and crypto markets may be open 24 hours a day. But hear this truth clearly. Only a few hours each day actually generate money. Trading outside those windows is not diligence. It is a slow, legal form of account suicide. Professional traders follow a very simple philosophy. Trade with liquidity. Never trade during the market's sleep. The global market operates across 3 primary sessions: Asia, Europe, and the United States. Each session has its own rhythm, personality, and type of capital flow. Asian session, Tokyo. This is the quiet session. Low volatility, thin volume. Price tends to drift sideways inside long, exhausting ranges. In this environment, spreads often widen due to lack of liquidity, and even a minor fluctuation can be enough to sweep your stop loss. The raw truth is this. If you attempt to trade pairs unrelated to the Japanese yen or the Australian dollar during the Asian session, you are not seeking profit. You are burning time and paying overnight costs for movements that are not worth the risk. European session, London. Capital begins flowing into the system. Major European banks step into the arena. Liquidity expands sharply. Market structure becomes clearer. Trends begin to form. This is when the market starts to wake up. United States session, New York, the peak of volatility. When the United States enters the field, volume reaches its maximum. Major economic releases, such as non-farm payrolls or Federal Open Market Committee decisions, hit the tape. Price no longer moves, it accelerates. This is where large waves form and real profits are created. The liquidity sweet spot. Most intraday trading profits do not come from sitting in front of a screen all day. They come from the overlap between the London and New York sessions, which typically falls in the evening Vietnam time. The reason is straightforward. The 2 largest financial centers in the world are active simultaneously. Liquidity peaks, while spreads and slippage compress to their lowest levels. Large clusters of pending orders and stop losses are triggered, producing decisive, unforgiving breakouts. Wall Street has always emphasized one core principle: energy equals opportunity. If you do not focus on high-energy sessions, you are deliberately rejecting the most efficient profit opportunities available. Time discipline. Trading is not an all-day job. It is a time-specific event. After choosing a market aligned with your personality, you must have the discipline to trade only when institutional capital shows up. If you cannot participate during the London-New York overlap, adjust towards swing trading or assets less dependent on session timing. Never trade simply because you are free. Trade when the market is willing to pay you. Factor 5, system review. The mandatory process of winners. In trading, the majority of the crowd is obsessed with hunting for a new strategy, a new indicator, as if profitability lives in something they do not yet possess. The truth is the opposite. No system is perfect, but only those who continuously review and refine their system ever reach sustainable profitability. Winning traders do not try to avoid every mistake. They do only one thing. They do not repeat the same mistake twice. And the only tool that enforces this philosophy is a trading journal paired with an uncompromising system review process. System review is not about counting wins and losses for appearances. It is a forensic examination of how you make money and how you give it back. Analyzing emotional drivers. Every trade carries a psychological state. Record what you felt at entry: confidence, hesitation, fear, or fear of missing out. At exit, document the reason with precision. The brutal reality is this: most losing trades are not caused by faulty technical analysis, but by disciplined breakdown under emotional pressure. Entries driven by fear of missing out and exits driven by panic, once identified and eliminated, immediately improve net performance. Quantifying profit patterns. Audit your entire trading history to answer a single question: which patterns pay you and which ones drain your account? You may discover that trades taken at major support and resistance zones deliver a high win rate, while another setup consistently bleeds capital. Refining a system is not about adding more. It is about concentrating on what generates profit and removing what destroys it. This is where the 80-20 rule truly asserts itself. Adapting to market conditions. Markets constantly change character. A system that thrives in strong trends can suffocate in sideways conditions, and vice versa. Regular system reviews reveal whether your current strategy still aligns with the market state. When the market shifts into consolidation, profit targets must tighten, and breakout thinking must yield to range trading. Failure to adapt equals elimination. Wall Street treats system review like a weekly board meeting for the business you are running, your trading account. No measurement, no improvement. No feedback, no growth. Remember this core truth. You do not need to change your system. You need to become a better operator of the system. Eliminate recurring errors. Maximize your highest performing setups. The system review process is the line that separates a gambler from a true portfolio manager. Factor 6. Optimal entry. The discipline of patience. After you have done everything right, chosen the market, selected the broker, defined the time frame, identified the trading session, and refined your system, it can all still collapse because of a single undisciplined mouse click. Here is the raw truth. Most potential profit is not lost at the stop loss. It is lost at the entry. Enter too early, enter poorly, and your probability of success is crushed from the very first second. Elite traders operate under a belief as rigid as steel. The market never runs out of opportunities. Only traders run out of patience. And in this business, patience is the most expensive currency of all. The truth about fear of missing out. Amateur traders enter because of fear, not because of signal. They see price start to move, and the fear of missing out pulls their hand to the button. The consequences are always the same. Stop losses are stretched because the entry is taken in the middle of nowhere, inflating risk per trade. Risk to reward ratios deteriorate. A minor pullback is enough to take the trade out. Or if the trade wins, the profit is insufficient to justify the risk assumed. That is not trading. That is emotional reflex. The Wall Street edge, the art of refusal. Consistently profitable traders do not trade often. They reject most signals. They show up only when probability tilts decisively in their favor. Waiting for premium price zones. When price breaks resistance, amateur traders rush to buy. Professional traders step back. They wait for the pullback, wait for the retest, wait for the market to confirm that the former resistance has flipped its role. It is precisely at this point that stop losses can be kept tight while profit potential expands multiple times over. A risk-to-reward ratio of 3-to-1 or better is not luck. It is the byproduct of patience. Checklist discipline. No complete checklist, no trade. One unchecked box and the trade is canceled. This approach turns trading into a cold, mechanical process, one in which emotions have no voting rights. The continuity of the 6 factors. The entry is where everything is tested. When you are patient enough to wait for an optimal entry, you are proving that you control fear of missing out and understand your own psychology. You trade during periods of real institutional liquidity. You adhere to a system that has been rigorously tested and reviewed. If you cannot wait 15 minutes for a perfect entry, you will never have the composure to hold a winning position for 2 days. Patience at entry is the foundation of all position-holding discipline, and the final line separating emotional traders from those who extract real money from the market. At this point, you can clearly see the true nature of the 80-20 rule. 80% of profits do not come from hunting for sophisticated secrets or mythical strategies. They come from mastering and optimizing 6 core factors, invisible, silent forces that nonetheless hold life and death power over your trading account. We have completed the full journey, from choosing a battlefield aligned with your inner nature, so emotions no longer control you, to building a trading foundation solid enough that profits do not leak away, to establishing a multi-time frame perspective that prevents you from getting lost in noise, to exploiting institutional capital during active trading sessions instead of trading while the market sleeps, to maintaining continuous evolution by reviewing your system like a real business, and finally, to proving true mental toughness through the patience required to wait for optimal entries. Etch this final philosophy into your mind. Trading is not a sprint. It is a process. When these 6 gears mesh perfectly, large profits do not need to be chased. They emerge as an inevitable consequence. Now, only one thing remains: Action. You already have the map. The question is no longer whether you know or do not know. The question is, do you have the discipline to follow it? If you are truly serious about turning trading into a profession, a stable income stream, and continuing to dive deeper into the most refined layers of Wall Street level trading psychology and strategy, here is what you need to do next. Subscribe to the Trading Mindset Lab channel. This is not a place for comforting narratives. This is where high performance trading mindset and systems are built. No fluff, no theatrics. Turn on notifications. Do not miss lessons that the market only teaches to those willing to pay the price. Leave a comment. Tell me which of the 6 factors is currently your biggest bottleneck. Right, I am ready to optimize these factors. That is not just a comment, it is a commitment to yourself. Thank you for staying with me until the end of this journey. I will see you in the next videos at Trading Mindset Lab, where mindset is sharpened and discipline is forged into profit.